I used to believe it for many years. Sharks are manipulating the market. It sounds very reasonable. Every time the price drops sharply, people say the sharks are dumping the price. Every time the price pumps hard, people say the sharks are driving the price up. Every time someone gets liquidated, people say the sharks are hunting stop losses. Gradually, sharks became the explanation for everything. Until one day, I realized something very hard to accept. Perhaps we have been overestimating the sharks and underestimating the thing that actually drives the market, which is the cash flow. Sharks don't create the ocean. They just swim better than everyone else. They don't create inflation. They don't dictate the economic cycle. They don't print money. They don't lower interest rates. They cannot force pension funds, central banks, or global corporations to buy an asset together if the macro cash flow isn't ready. But they possess one ability that the crowd lacks. They are patient enough, cold enough, and disciplined enough to stand exactly where the crowd is forced to sell. That is what is truly terrifying. Beginners look at the candlestick. Professionals look at liquidity. Beginners look at the green color. Professionals look at whether real cash flow is actually returning. Those are two entirely different worlds. One side looks at what is happening. The other side looks at what is about to happen. I used to think a trend began with beautiful candlesticks. Later on, I understood. Beautiful candlesticks are usually just the result, not the cause. A real trend only appears when three things meet at the exact same time. Macro cash flow changes direction. Forced selling pressure gradually comes to an end. And smart money begins to see a risk-to-reward ratio that is attractive enough. Missing just one of the three, the trend is usually nothing but an illusion. That is why the most dangerous thing in the market is not the red candle. It is the green candle. A green candle appears exactly when you want to believe that everything is over. A green candle beautiful enough to make you forget that liquidity is still shrinking. A green candle strong enough to make you think you are about to miss a life-changing opportunity. And then, you buy. Right before the market turns around. The market doesn't need to deceive everyone. It only needs to make enough people mistake a single bounce for a new trend. That is enough. There is another truth. Very few people want to hear it. Open interest drops sharply. A wave of positions gets liquidated. Extreme volatility. That does not automatically mean the market has bottomed out. It only shows one thing. Leverage is being burned away. Pressure is being released. As for whether it is a real bottom or not, you must let the cash flow answer. Not emotion. Many people spend all day guessing what the sharks are doing. But that is the wrong question. The right question is, where is the real cash flow moving toward? And where are the sharks standing within that current? Just a single question's difference. But sometimes, it dictates the difference between someone who always chases the price and someone who is beginning to understand how the market operates. The crowd usually thinks sharks pump the price. In reality, sharks only amplify what has already begun to form. They don't create the tide. They just see the tide earlier. When the tide turns, they get on the boat. When the tide recedes, they get off the boat. It is that simple. Today, everything is even more complex. Large institutions no longer rely solely on humans. They use AI, quantitative models, massive data processing systems, news, liquidity, volatility, interest rates, ETF fund flows, derivatives data. Everything is processed almost in real time. But there is one very interesting thing. AI doesn't create the rules. AI just reacts faster to the rules. People are usually afraid of AI. But the terrifying thing is not AI. It is the fact that so many people are still trading with emotion while their opponents are trading with probability. At some point, I stopped looking at the market as candlesticks. I started looking at it as a sine wave. Moments of rise. Moments of fall. Moments of euphoria. Moments of despair. Moments of greed. Moments of fear. No uptrend lasts forever. No downtrend exists forever. The important thing is not guessing the exact top. Nor is it catching the exact bottom. The important thing is realizing which point the sine wave or the pendulum is leaning toward. Those who look at colors usually find out very late. Those who look at the rhythm usually recognize it much sooner. Colors deceive the eyes. Only the rhythm tells the truth. That is why I always say, don't stand in the middle of the battlefield. Don't go full position. Don't use up all your ammunition just because of emotion. Cash is also a position. Not trading is also a trade. Sometimes the decision that makes the most money is the decision to do nothing at all. The biggest mistake of beginners is thinking their task is to guess the sharks. No. The first task is to survive. Protect capital. Protect the ability to participate in the next game. Because the market does not reward those who trade a lot. It doesn't reward the smartest person. It doesn't reward the person who guesses right the most. It only rewards those who remain long enough. Volume increases. Prices do not always rise. Open interest drops. It does not always reverse. DXY rises. Crypto does not always fall. ETF outflows. Bitcoin does not always plummet immediately. There is no holy indicator. There is no holy grail. There is only probability. And probability is always changing. Beginners make money by trading. Professionals make money by waiting. Beginners fear missing out on an opportunity. Professionals fear losing an edge. Beginners want action. Professionals want to wait for the probability to be on their side. Having walked this path long enough, I realized the market has never asked how many times I was right. It doesn't care how smart I am. Doesn't care how many books I've read. Doesn't care how badly I need money. It only asks one single question. A cold question. A question that every trader ultimately must face. Do you still have capital to keep playing? And that was when I understood. The market is not a place for those who want to prove they are right. The market is a place for those who know how to survive long enough to catch the real wave. Sharks don't create fear. They're just patient enough to stand exactly where the crowd is forced to sell. The current context of exhaustion. When macro-gravity strangles the lifeblood of liquidity, there is one thing that most investors only understand after losing a lot of money. The market does not collapse because of a red candle. It collapses because cash flow silently vanished long before that. Every crisis begins in silence. Inflation appears. Interest rates rise. The currency strengthens. The cost of living escalates. Those numbers seem to only exist on economic news broadcasts. But in real life, they're doing one very simple thing. They're taking money out of the pockets of millions of people. When electricity bills increase, gas prices increase, food prices increase, people are forced to cut back on risky investments first. It is not because they hate Bitcoin. Nor is it because they have run out of faith. But because they need money to live. That is the real cash flow. And it is that very cash flow that decides the direction of the market. The mistake of so many people is only looking at the price chart. But the price chart only tells you what has already happened. The thing that decides what is about to happen is liquidity. When the USD strengthens, cash begins to return to safe assets. When bond yields are more attractive, large investment funds naturally reduce their weight in risky assets. When US stocks weaken, crypto rarely stays out of it. Not because the two markets are the same, but because they are sharing the same blood. That is the global capital flow. Many people ask me, so is someone intentionally suppressing the price? No. At least, that is not the most important question. The more valuable question is, if the liquidity of the whole system is draining away, who will be strong enough to buy the entire amount of goods that the crowd wants to sell? That is the real problem. When there is no longer new cash flow entering the market, every recovery rhythm becomes fragile. One green candle can appear. Two green candles can also appear. But if behind them there is no cash flow confirmation, Then many increase rhythms are just the silence before the market continues to search for a new equilibrium point. Experienced traders rarely ask, "Is the price up or down today?" They observe something else. Is the volume expanding? Is new money really entering the market? Are the large timeframes in agreement? Or is it all just a bounce within a larger downtrend? The price board does not know how to lie. But the one looking at the price board can very easily lie to themselves. They see green. Then call it hope. They see red. Then call it doomsday. While the market is only reflecting exactly one thing: where the cash flow is going. That is the reason I always say, don't start by analyzing the candle. Start by analyzing the gravity of the cash flow. Because while liquidity continues to withdraw from the system, the price may recover. But it is very difficult to create a sustainable uptrend. And vice versa. When the real cash flow returns, many people are still preoccupied looking at yesterday's fear. They sell where others begin to buy. Not because they lack intelligence, but because they look at the price, while the market is being decided by the cash flow. That is the first lesson. If you want to understand the behavior of large capital flows, don't look at the noise on the chart. Look at where liquidity is silently shifting. Because the true trend is always born from cash flow, not from emotion. The market controllers do not fight against the cash flow. They go with it. Have you ever wondered why so many people always blame the sharks every time the market drops? They say the sharks are crashing the price. Every time the market rises, they say the sharks are pumping the price. It sounds reasonable. But if everything were that simple, then the rich wouldn't even need to care about macroeconomics, interest rates, or global capital flows. The truth is usually less dramatic. But it is a lot more terrifying. Large cash flows do not exist by fighting against the market. They exist by reading the market faster than the rest. A giant ship cannot run against the ocean current. It can only choose the right moment to set sail. Money is the same. When global liquidity is abundant, risk is accepted more. Money flows into stocks. Money flows into crypto. Money flows into places that promise high returns. But when interest rates rise, when the cost of capital becomes expensive, when instability spreads, cash flow begins to change direction. At that time, the wisest thing is not trying to hold the price, but accepting that the buying force has weakened. A lot of retail investors make the same mistake. They see the price drop, then think, this is definitely an opportunity to catch the bottom. But they forget one important question. Who will be the next buyer after them? If new cash flow has not appeared yet, every price-supporting effort becomes fragile. That is the reason sharp decrease rhythms often tend to self-amplify. Not because someone possesses infinite power, but because when a support level is broken, stop-loss orders begin to trigger. Accounts using leverage are forced to reduce their positions. A part of the selling pressure comes from the very risk management mechanism of the market. That effect is just like a snowball. At first, it is only a small stone. But the more it rolls, the more snow it sweeps along. That is when the crowd begins to panic. They sell because others sell, rather than selling for value anymore. And exactly in those moments, large cash flows usually do not act on emotion. They observe. They wait. They let the market release most of its own pressure by itself. That is not coldness. That is discipline. You will realize a paradox. The crowd always tries to guess the reversal point. Those with plenty of experience, however, wait for a confirmation sign. They don't need to buy at the exact bottom. They need to buy when the probability is already on their side. Accepting the loss of the first few percent in exchange for a trend with a foundation. That is a very worthwhile trade. Because the thing that kills an account is not missing an upward rhythm. The thing that kills an account is continuously buying into recovery rhythms that do not have real cash flow behind them. There is an interesting thing. When the market begins to recover, the crowd usually looks at the green color. But professional people look at the volume. Is the price increasing along with liquidity? Is new cash flow really returning? Or is it just that the number of sellers has temporarily decreased? Those three scenarios all create green candles. But their meanings are completely different. That is the reason. A good trader never only reads the chart. They read the context as well. They know that a trend is not created by a single candle. It is created by the consensus of cash flow over time. Therefore, if you want to understand the behavior of large capital flows, don't try to guess what they are thinking. Observe what they are being forced to do in the current context. Because smart money does not win by predicting the future. Smart money wins because it always stands on the same side as probability. And that is exactly what creates what many people call the speed governing algorithm. Not controlling the market, but adjusting one's own pace, so as to never have to go against the cash flow. True trends and fake trends. The thing that makes the majority of traders lose money is not the price, but the misconception. You look at the price board. The green color appears. What is the first emotion? The market has turned around. Another candle appears. Greed begins to grow larger than fear. By the third candle, the crowd is almost fully convinced. The uptrend has returned. But do you know what the most interesting thing is? The market does not need to trick you. It is our own brains that always rush to a conclusion. With just 3 green candles, we immediately see an entire bull market. With just 3 red candles, we imagine doomsday all over again. The market does not create illusions. Human beings are the ones who create illusions. That is the starting point of every mistake. A true trend is not born from the color of the candle. It is born from cash flow. If the price increases, but the volume does not expand. If the large timeframes are still not in agreement. If the capital flow has still not returned. Then the thing you are seeing may only be a technical recovery rhythm. It is like a person who has just surfaced for air. It does not mean they have swum to shore. On the contrary, a sustainable uptrend is usually very silent. At first, no one believes. The news is still bad. The crowd is still afraid. The experts continue to forecast a decrease. But behind the price board, a very small thing is changing. The volume begins to expand. The selling force grows weaker. The correction rhythms become shallower and shallower. The large timeframes gradually shift from contradiction to agreement. That is when the trend is born. Not on the screen, but in the cash flow. There is a mistake that I used to repeat many times. Seeing the price rise, I immediately thought I must buy right away. After that, the price turned around. I told myself again, it is probably just a correction. Then the correction turned into a drop. The drop turned into a stop loss. In the end, I did not lose because of the market. I lost because I mistook a recovery rhythm for a trend. That is the most expensive lesson. Long-time traders very rarely ask, is this candle beautiful? They ask a different question. Behind this candle, is anyone putting real money in? If there is no new cash flow, every rise has a limit. If there is no next buyer, every expectation is just an expectation. The market always needs fuel. And its only fuel is cash flow. Have you noticed? During weak market phases, many upward rhythms happen very quickly. So quickly that it makes the one standing outside impatient. They are afraid of missing out. They begin to chase the buy. But precisely because it is too quick, it lacks a foundation. A building cannot stand firm if you only build the upper floors. The market is the same. A true trend always needs time. It needs retests. It needs correction rhythms. It needs volume confirmation. As for a fake trend, it usually only needs emotion. There is a paradox very worth reflecting on. The crowd always likes sharp increases. Those with plenty of experience, however, like slow increases. Because an increase that is too fast usually consumes most of the energy right from the start. While a persistent upward trend continuously attracts more new cash flow. That is the true foundation of a major cycle. Therefore, Don't ask if the market is green or red today. Ask, what is backing that green color? If behind it is real cash flow, be patient and go with it. If behind it is only temporary excitement, let the crowd run first. A good trader does not make money by reacting the fastest. They make money because they distinguish between what is a movement and what is a true trend. That is a very small difference. But it is enough to create the gap between a person who continuously chases the market and a person who always steps one rhythm ahead of the market. The green illusion, the red illusion. The market does not defeat you with price. It defeats you with emotion. Do you know what the most dangerous thing in the market is? Not a 20% drop, nor a vertical upward session. The most dangerous thing is when the market makes you believe you have seen the truth. Because from the very moment you believe absolutely, your defensive capability also disappears. That is when mistakes begin. I used to think I traded because of the chart. Later I understood. I traded because of the emotion that the chart created. A green candle makes me see hope. 3 consecutive green candles make me see confidence. 5 green candles make me afraid of missing the opportunity. It is that very fear of being left behind that made me press the buy button. Not because I saw the cash flow, but because I could not bear the feeling of others making money while I stood outside. The market does not need to force you. It only needs to let greed do the rest of the work. Now look at it from another angle. Suppose after many days of sharp decreases, the market suddenly bounces up. The news begins to be less negative. Social media appears with status lines. It is the bottom. The new cycle has begun. If you don't buy now, there will never be another chance. Does it look familiar to you? The noteworthy thing does not lie in those sayings. The noteworthy thing is that they often appear at the same time. That is when emotions spread faster than data. This person looks at that person. That person looks at the price board. Then everyone together confirms each other's belief. A psychological loop is formed. No one intentionally tricks anyone, but everyone accidentally amplifies the same expectation. On the contrary, after a series of deep drops, everything also happens in a similar way. The red color covers the price board. Bad news appears rapidly. Pessimistic forecast statements become overwhelming. At that time, not a few people sell out, not because they have reanalyzed the asset value. They sell because they can no longer bear the feeling of insecurity. The market understands that very well. It knows human beings tend to act the strongest in 2 states. When too greedy, and when too afraid. That is the reason I rarely ask, is the price increasing or decreasing? I often ask, what is making the majority of people believe in the same direction? If everyone is excited together, I begin to be cautious. If everyone is in despair together, I begin to observe. Not because the crowd is always wrong, but because when everyone has already acted together, most of the decisions usually have already been reflected in the price. There is a very interesting detail that many people overlook. A healthy trend does not only need the price to increase. It needs volume, time, and consensus as well. If the price increases but the volume does not improve, put a question mark. If the price increases but only a few small timeframes confirm, put a question mark. If the price increases but the new cash flow still stands outside, continue to put a question mark. Don't rush to deny the market. Just don't rush to believe in what you want to believe. I used to lose a lot of money just because of one habit. I liked confirming my own belief. When I had bought, I only read the good news. When I had sold, I only looked for the bad news. I no longer looked for the truth. I only went to find evidence to protect my own decision. That is not analysis. That is bias. And the market does not pay for bias. Experienced traders have a very strange habit. They don't try to prove themselves right. They always find ways to prove themselves wrong. If the market continuously dismisses their hypothesis, they are ready to change. No hurt pride. No stubbornness. No arguing with the price board. Because they understand a very simple thing. The market does not know who you are. It also does not care how long you have researched. It only reflects where the cash flow is flowing. Therefore, don't believe too much in the green color, nor be too afraid of the red color. Both can be signals, but both can also be just short-term reactions of emotion. The thing worth your observation is not the color of the candle, but the weight behind that very candle. Is there real cash flow? Is there consensus of the large timeframes? Is there a liquidity foundation strong enough to maintain the trend? If the answer is still not clear, don't let emotions answer instead of data. Because the market rarely defeats us with volatility. It defeats us by making us act precisely at the moment emotions reach the extreme. The sharks do not create cash flow. They only amplify it. Never think that if sharks want to pump the price, they pump it. And if they want to crash the price, they crash it. If that were true, then there wouldn't be multi-billion-dollar investment funds that still go bankrupt. The cold truth is, no single organization is large enough to win against the cash flow of the entire economy. The only thing they do better than the crowd is reading the flowing direction of the cash flow a few steps ahead. The biggest mistake of retail investors is always imagining they're trading with the chart. No. You are trading with liquidity. Price is only the shadow. Liquidity is the body. And sharks never fight against the body of the market. They only bend the direction of the shadow. When inflation rises, interest rates anchor at a high level. The USD strengthens. ETFs continuously experience capital withdrawals. Then the source of new money entering risky assets will grow weaker. That is not emotion. That is the law. If the entire river is drying up, then no one is strong enough to create a tide. At that time, the crowd still shouts, "It is the bottom. Just buy." The sharks will pump. But sharks understand a very simple thing. Without new money, pumping up is only to sell into oneself. That is the fastest way to lose money. And they are not stupid. Instead of fighting against the cash flow, they do the opposite. They let the market fall. Not because they like it, but because that is the path that consumes the least energy. Just like a rock rolling down a hill. You don't need to push. Just let go. When the price begins to decrease, the crowd begins to fear. Margin begins to stretch. Stop losses appear densely. Liquidation robots operate. New selling force creates yet more selling force. A fall. Self creates more acceleration for its own self. That is exactly what the sharks need. Not because they sell more, but because the market sells for them by itself. The twist lies here. The crowd thinks sharks create the drop. In reality, it is the fear of the crowd that creates the drop. The sharks only stand in the exact position to observe. Then there will come a moment when everyone is in despair. Bad news covers the media. Everyone says, crypto is dead. That is instead the time when experienced people begin to look at something else. Not the price, but how much of the selling force is left. If everyone has already sold, then who will sell next? If the selling side is exhausted, with only a just enough amount of demand, the balance will change direction. That is the law of supply and demand. Not a miracle. Therefore, the first recovery rhythms after a sharp drop are not always a new trend. A lot of recovery rhythms are simply the sellers are temporarily gone. Not that the buyers have become very strong. Those two concepts are completely different. Inexperienced people look and see a green candle. Experienced people look to see, is the volume confirming? Is the cash flow returning? Are the large timeframes in agreement? If not yet, they remain patient. An increase without liquidity is like a house built on sand. It can stand for a few hours. It can stand for a few days. But it is very difficult to stand for long. The most dangerous thing is not that the market decreases, but that the market makes you believe everything is already safe, while the foundation still has not changed. Therefore, don't try to guess what the sharks will do. Observe the larger thing. Where is the cash flow going? Because in the end, The sharks also have to follow that very answer. Chapter ending. The newcomer always asks, "What are the sharks thinking?" The experienced person instead asks, "What is the cash flow thinking?" The two questions differ by only a few words. But the gap between them is sometimes an entire cycle of winning and losing. True trends and fake trends. Don't let the green color decide your wallet. You look straight into this camera. The majority of investors out there have never traded according to the trend. They are only trading according to the color. Green candle, then excited. Red candle, then afraid. But the market has never promised that the green color equals an increase, or the red color equals a decrease. That is the biggest trick. A true trend does not start from the candle. It starts from the cash flow. If the money has not entered yet, then every beautiful candle is only an image. If the liquidity has not confirmed yet, then every breakout could just be a test. There is a sentence that many people take many years to understand. The price can run ahead for a few hours, but the cash flow never lies for too long. That is the reason those who only look at the chart usually arrive late and leave with their very own money. When the economy enters a difficult phase, high interest rates, capital flows shrinking, ETFs reducing their money attraction, then the foundation of an uptrend also grows weaker. At that time, every recovery rhythm must be put under a question mark. Not because they will definitely fail, but because they have not been proven. This is the difference between an emotional trader and a probability trader. The first person asks, "Is the price increasing?" The second person asks, "Who is buying?" If the volume increases, multiple timeframes confirm together, real cash flow returns, then the possibility of forming a sustainable trend will be higher. If only the price increases, while liquidity does not improve, then that is only a hypothesis, not yet a conclusion. The twist of the market lies here. A lot of sharp increases are not aimed at bringing you to profit, but aimed at bringing you to a wrong decision. Have you noticed? After a phase of very sharp decreases, just with a few green candles appearing, social media immediately changes its voice. It is the bottom. The new cycle has begun. The train is running. But precisely at the moment the crowd shouts to buy in unison. The experienced person begins to observe more carefully. They don't rush to believe in the price. They check volume, market structure, supply and demand zones, the consensus of the large timeframes. If the puzzle pieces do not match yet, they still stand outside. Standing outside is sometimes the decision that earns the most money. Because not losing money is also a form of profit. On the contrary, a true downtrend also does not form just because of a few red candles. A drop is only terrifying when the selling force spreads, the liquidity confirms, important support zones are broken one after another, the cash flow continues to withdraw. At that time, going against the trend just because of thinking it is cheap now can be very expensive. Someone asks, "How do you know which is a true trend?" The answer is, you never know for sure. You only continuously verify. That is the mindset of a survivor. The market does not reward the one who guesses right. The market rewards the one who knows how to wait for enough evidence. A newcomer usually tries to catch the exact bottom. An experienced person is ready to miss the first 10%. In exchange for a higher probability in the remaining 90%. They understand. No need to buy the cheapest. Just need to buy right. And that is the thing that makes them different. They don't run after the candle. They run after probability. Not running after the cheering. They run after the cash flow. Not running after emotion. They run after discipline. Chapter ending. The market draws thousands of candles every day. But there are only very few candles that actually change the trend. If you learn how to distinguish between those two things, then the thing you keep back is not just profit, but also calmness. And in the financial market, that is instead the most precious asset. The green illusion, when greed makes human beings trap themselves. Do you notice a very strange thing? The market rarely takes your money while everything is at its worst. It usually takes the money exactly at the moment you begin to feel reassured. That is the reason the first upward rhythms after a sharp drop are usually much more dangerous than many people think. Human beings have a weakness very difficult to fix. We are not afraid of losing opportunities. We are afraid of others making money before us. And just as that feeling appears, reason begins to leave the trading table. A few green candles. A few positive headlines. A few people showing off profits. Just like that, the crowd concludes on their own. The uptrend has returned. But the market has never confirmed that. It is our own brains that confirmed instead of the market. This is exactly the thing I call the green illusion. Not because the green color is wrong, but because human beings too easily attach to it a meaning that it does not have yet. A technical recovery rhythm can be just a technical recovery rhythm. A short recovery phase does not automatically become a bull market. A few beautiful candles cannot replace real cash flow. The newcomer looks at the price. The experienced person looks at the foundation of the price. If the foundation does not change, then the floating part can very easily disappear. You try to remember back. How many times has the market increased beautifully for a few hours? Then everything disappeared in just one session? That happens not because the chart betrayed you, but because you believed in the first signal, instead of waiting for a confirmation signal. The twist lies here. The market does not need to force you to buy. It only needs to make you believe that. If you don't buy today, tomorrow you will regret it. Just that. You will press the button yourself. FOMO has never been an emotion. It is a survival mechanism of human beings. We are afraid of being left behind. And the market understands that very well. That is the reason recovery rhythms usually last just long enough. Not too short for you to doubt. Not too long for you to stay calm. Just enough for caution to turn into confidence. And confidence turns into greed all over again. There is a very interesting paradox. When the risk is highest, the human feeling is the safest. While when the best opportunity appears, everyone is the most afraid. That is the reason the crowd usually buys near the top and sells near the bottom. Experienced people don't hate green candles. They just don't love them too early. They let the market prove itself. They wait for liquidity to confirm. They observe the large timeframes. They check to see whether the buying force is truly expanding or not. If not yet, they continue to wait. Patience always looks like missing out. Until the market turns around. Don't misunderstand. Not every increase is a trap. A lot of major uptrends also start from the first green candles. The difference lies in the fact that a true trend will be confirmed by the cash flow, while an illusion is only confirmed by emotion. That is the reason a good trader does not ask, "Should I buy?" They ask, "What will make me know I am wrong?" Only when that question can be answered do they enter an order. The market does not reward the one who acts the fastest. It rewards the one who acts at the right moment. Fast does not equal right. Chapter ending. The green illusion does not lie on the chart. It lies inside the brain of each of us. The market only gives a few candles. It is greed that turns them into a dream. And it is also greed that turns that dream into a bill to be paid. The red illusion, when fear forces you to sell exactly when others want to buy. If greed makes the majority of investors buy too high, then fear instead makes them sell exactly at the most painful moment. That is the biggest paradox of the market. People don't lose money because the price decreases. People lose money because they cannot bear the feeling that the price is decreasing. When the price board is covered in red, everything seems to confirm one thing. The news is bad. Social media is pessimistic. Experts forecast deeper drops. Friends advise standing outside. At that time, the human brain no longer analyzes. It only wants to escape the pain. And that is exactly the most dangerous moment. Not because the price will definitely increase, but because emotion has begun to replace reason. There is a very interesting law. When more and more people believe that, the price will decrease further. Then the market gets closer to the moment when there are not many people left to sell. That is the reason experienced people always ask one more question. Who else is left to sell? If the selling force is still strong, they continue to wait. If the selling force begins to weaken, they begin to observe. Not to buy right away, but to see whether the balance of supply and demand is changing or not. The feeling, the most terrifying thing in the market, is not that the price decreases, but the fact that everyone thinks the price can only decrease. Because precisely when consensus reaches the extreme, the market usually begins to look for the opposite direction. A sharp drop always creates two things: damage to money and damage to faith. The second thing usually lasts longer. After consecutive downward sessions, the crowd no longer wants to hear the word buy. They only want to keep money. That is a completely natural reaction. But exactly at that time as well, probability traders begin to work. They don't try to guess the bottom. They don't rush in to catch falling knives. They only calmly observe. Is the volume still expanding? Is the selling force still aggressive? How do the long-term support zones react? Do the large timeframes begin to stabilize? If the answer is still not yet, they continue to be patient. If multiple signals gradually agree, only then do they consider acting. That is the difference. The newcomer reacts to the red color. The experienced person reacts to the data. Don't forget one thing. Not every drop is an opportunity. There are markets that decrease for a very long time. There are assets that never return to their old peak. Therefore, don't buy just because the price has decreased a lot. Buy when there is a reason to believe that the probability has changed. An inexperienced person usually thinks, the price has decreased 50%. Surely it cannot decrease further. The market does not care about that thought. An asset that decreases 50% can still decrease another 50%. That is the reason discipline is always more important than courage. Courage at the wrong time is only recklessness. There is a sentence very worth remembering. The market never forces you to sell at the bottom. It is fear that does that. When you learn how to separate emotion from your decision, the red color will no longer be a threat. It is just a normal part of the cycle. Chapter ending. The green illusion strikes at greed. The red illusion strikes at fear. But both share the same goal: making you make decisions with emotion. By the day you no longer trade with emotion, the market will still fluctuate, but it will find it a lot more difficult to take your money. I am Sam. After everything we have just gone through, the most important thing I learned was not how to guess the price, but how to understand myself. Sam once said a sentence that I remembered for a very long time. Don't try to win every wave. Survive through every wave. At first I thought it was just a piece of advice. Later I understood. That is the nature of investment. The market does not reward the smartest person. It does not reward the one with the most money. Nor does it reward the one who predicts correctly the most. It rewards the one who still exists after enough cycles. Sam did not teach me to look at the candles. He taught me to look at the context. A green candle says nothing if the cash flow has not changed yet. A red candle also says nothing if the selling force is already exhausted. If you want to understand the market, don't just look at what is happening. Look at what is making it happen. Sam also did not teach me that I must buy a great deal. The thing he reminded me of the most was instead knowing when not to trade. There are days when standing outside is instead the decision that brings back the most profit. Because keeping money is always the first condition to earn money. Another lesson I will never forget. Don't let a single trade decide the emotion of your whole life. Winning a trade does not make you a genius. Losing a trade also does not turn you into a failure. Each trade is only a test of probability. Don't turn it into self-esteem. Sam always reminded me, don't fall in love with your position. If the data changes, be ready to change. The market does not pay for stubbornness. It only pays for adaptation. The thing I am most passionate about is not an indicator, not a pattern, but an attitude. Disciplined when everyone is excited. Calm when everyone is in panic. Saying it is simple. Doing it takes very many years. And in the end, Sam saw one thing clearly. The financial market is not a place to prove oneself right. It is a place to manage risk. You don't need to win everything. You only need to let the times you are right be larger than the times you are wrong. If after this video, you only remember just one thing, then remember this thing. Don't try to become the person who predicts the future. Become the person who is always prepared for many different possibilities. Because in the market, the person who exists the longest is usually not the best forecaster, but the most disciplined one. Closing words. The chart will still change. The news will still change. The cycle will still change. But there is one thing that never changes. That is human emotion. Whoever controls emotion will control the decision. Whoever controls the decision will have more opportunities to control the outcome. And perhaps, that is instead the biggest lesson I learned from Sam. The market does not need to deceive everyone. It only needs to make the majority believe in the same thing at the same exact moment. This is the most interesting highlight of the financial market.